There are a lot of ways to save money on taxes, but only a few that actually result in meaningful savings. In this video, I'm going to review 4 strategies that will likely have the biggest impact on your tax bill. Let's get into it. Welcome back to another video from One Up Financial. I am your host, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter in retirement. I thought about putting together a video discussing the many different ways that investors can save money on taxes, much like a lot of other financial institutions do right around this time. But after reading through some other tax tip related content, I realized that sometimes less is more. Yes, there are a lot of ways to save money on taxes, like getting the above the line charitable deduction of $600 or saving to a traditional IRA. But when you really break them all down, there are only a few strategies that can significantly improve your tax situation. And that is what I want to review in this video. It's those strategies that are going to potentially save you thousands of dollars in taxes, not just a few hundred. But before I begin, I just want to go over a few housekeeping items. So number 1, all of the things that I discuss in this video may have some income limitations associated with them, meaning if you make too much money, some of these strategies might not work for your situation. Second, the deductions and the tax credits that I review are going to apply for 2022, the current year that we're in. And lastly, this probably should go without saying, but for compliance purposes, I have to say it, that nothing in this video should be construed as tax or financial advice. Please consult your tax or financial professional before carrying out any of the strategies discussed in this video. Okay, so without further ado, let's start with number 1, which is to maximize your pre-tax company retirement accounts. Now, I know that this may sound like stock financial advice, but just hear me out and let me explain. The average 401k participant savings rate in 2021 was 13.9%. So equating that to dollars, if we assume that the average participant, let's say, makes $100,000 a year, that means that they're putting away about $13,900 each year into their 401k or their 403b, which is not a small chunk of change by any means. But when you compare that to the maximum amount that you can contribute, which in 2022 is $20,500 plus an additional $6,500 in catch-up contributions if you're over the age of 50, the average participant is actually leaving a lot on the table. If instead the average employee decided to maximize their 401k and they were over the age of 50, and let's assume that they're in a marginal tax rate of 20% to make the math simple. So if this average 401k participant decides to instead max out the amount they can put into their 401k, that would equate to an additional tax savings of roughly $2,600 just by maximizing your 401k contributions. Now, there's some other company retirement plans that I want to make sure you're aware of, and this is probably more applicable if you're a small business owner. So there's 3 that I want to point out. 2 of them, the SEP IRA and the solo 401k, better suited for the sole proprietors and the small business owners who don't necessarily have employees or don't have a lot of employees. They may have some independent contractors or some part-time people. So for the SEP IRA and the solo 401k, the maximum amount that you can contribute 2022 is $61,000. Now, if you're a small business owner and let's say you have a few employees, then maybe a simple IRA would be better suited for you. A simple IRA, you can contribute $14,000 plus an additional $3,000 in catch-up contributions if you're over the age of 50. Now, if your spouse works in the business and they're earning a wage or they're getting paid some kind of income, then they too can contribute to a simple IRA. So if they're over the age of 50 like you, they can put in $14,000 plus the $3,000 catch-up. So if you're both maximizing your simple IRA contributions. The total amount you can save in 2022 is $34,000. Now, as I said earlier, these amounts will be changing. These amounts are only for 2022, and they've already released the 2023 figures. So please stay tuned for future videos next year that will encompass these new limits. Number 2, offset income and capital gains with losses. Unfortunately, the IRS limits the amount that we can deduct from investment losses on a return up to $3,000 per year. What some investors miss, though, is that these losses can offset 100% of investment gains. And the easiest way to illustrate this, I think, is with an example. So let's say we have someone with a legacy stock position in Apple. Let's say that this person purchased Apple stock several years ago for $50,000, and now the value of that stock is worth $250,000. If this person decides to sell the stock, they'll obviously have to report that $200,000 in gains on their tax return. And if they have long-term capital gain treatment, and let's assume the 15% long-term capital gains tax rate, if they sell that stock, the full amount, then they're going to have an additional tax bill of roughly $30,000. But being the diversified investor that this person is, let's say they also have another portfolio that's more diversified into ETFs and index funds and so on and so forth. And this portfolio was initially purchased for $250,000 and now has gone down to $200,000. So we have an unrealized loss of $50,000 in this portfolio. So if this individual decides to, let's say, harvest the losses in that diversified portfolio, meaning sell those investments to capture the loss and then reinvest the proceeds into something different, then the investor will only be able to deduct $3,000 in losses against their return in year 1, with those additional losses, that additional $47,000, being carried forward to future years. But what if instead of just harvesting those losses and doing nothing else with the Apple stock, what if instead this individual sold $62,000 worth of Apple stock, which would equate to approximately $50,000 in gains, just based on the value that Apple was purchased for and what it's currently worth. So if this individual sold $62,500 worth of Apple stock, they would have approximately a $50,000 gain on their sale. Now, if nothing else happened, that $50,000 in gain would be taxed at 15%, and there would be a substantial tax liability due. But if this person took that gain, that $50,000 gain, and used all of the $50,000 in losses and harvested the losses in that diversified portfolio of index funds and ETFs, then they'd be able to use all of that $50,000 in losses to offset the gain that they took on the sale of their Apple stock. And just by doing that, this person could save approximately $7,500 in capital gains tax just by utilizing all of the harvested losses to offset the gain on the sale of their Apple stock. Using investment losses to offset ordinary income and capital gains can lead to more tax savings than you may think. Number 3, take advantage of tax credits. A tax credit is a dollar-for-dollar reduction in your tax liability and far more valuable than a tax deduction. So it's important to pay attention to any tax credits that you may qualify for. And here are 4 that I think you may want to keep on your radar. Number 1 is the home energy tax credit, which applies if you've made energy efficient improvements to your home. Second is the child adoption tax credit, which amounts to $14,890 per eligible child. Next is the electric vehicle tax credit, or EV tax credit, for qualifying purchases of all electric and or plug-in hybrid vehicles. Now, the credit amount varies depending on the make and model of the vehicle that you purchase, but the maximum, for at least for 2022, is $7,500. Last but not least is the American Opportunity Tax Credit. This is available for college tuition costs incurred for a student's first 4 years of college. And the maximum credit here is $2,500 for each qualifying student. So let's just put this all into perspective and let me run through a scenario for you. If we have a married couple and let's say they have a tax liability after they prepare their tax return, before they file, they see, oh my gosh, we owe $26,000 in taxes. Wow, we really screwed something up. We just didn't withhold enough. What are we going to do? Now let's assume that they made enough energy improvements to their home to qualify for the maximum tax credit. Let's also assume that they adopted a child, that they purchased a 2022 RAV4 Prime plug-in hybrid, and lastly, they paid for their child's first year tuition at Penn State, and that they stayed within the income limits to be able to capitalize on all of these tax credits. If they did all that, then they would see that their tax liability of $26,000 be reduced to zero. Now, obviously, you may not qualify for all of these tax credits, but even if one or two apply, that could end up saving you thousands of dollars in taxes. Lastly, number 4, and this is my favorite, and I'll explain why: bunching your tax deductions. So with the passing of the Tax Cuts and Jobs Act of 2017, most folks who were accustomed to itemizing their taxes have since been forced to take the standard deduction, given limitations imposed on certain state and local tax deductions, otherwise known as the SALT deductions. But behold, there is a workaround if you're willing to take some heat from your local taxing authorities. So, true story. Back in 2017, I heard about the changes coming to the tax code, and I knew that my real estate taxes would no longer be deductible on my tax return. I would be forced to take the standard deduction. So what I did is I prepaid my 2018 taxes entirely in 2017 to get the most out of my tax dollars. Now, the only downside to this was a nasty phone call that I received from the county clerk's office telling me that I'm not allowed to do this anymore because it's very difficult for them to account for prepayments on real estate taxes. So I apologized, hung up the phone, and later filed my taxes and collected a fairly hefty refund for that year. But prepaying real estate taxes is only one option that investors can look to lump their tax deductions in 1 year. Another common one, charitable donations. If you're used to donating a set amount of charitable contributions each year, you may decide to lump those contributions into 1 year into what's called a donor advised fund. Now, a donor advised fund is simply just an investment account set up so that donors can make charitable contributions to an investment account, receive an instant tax deduction for the amount that they contribute, and later determine when and where they want their dollars to be donated. So let's run through a quick example here. If Joe and Jane Smith donate $5,000 each year to various charities, they may not be able to deduct that amount on their taxes if their total itemized deductions are below $25,900, which is the standard deduction limit for married filing joint couples in 2022. If, however, they decided to, instead of giving $5,000 each year, lump, let's say, 5 years worth of those charitable donations into 1 year, assuming they have the funds to do that, if they were to lump $25,000 in this case to a donor advised fund, then they'll likely receive a hefty tax benefit come April 15th. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.